This is Horizons Middle East and Africa. Our top stories this morning. Relief rally. Stocks and the dollar rise after President Trump says he has, quote, no intention of firing Fed Chair Jay Powell. Mideast mission. The US president plans a return visit to the region in May as he seeks to confirm trillions of dollars in investment from Saudi Arabia, the UAE and Qatar. And the IMF slashes its global growth forecast for this year and next, warning it could get worse if US tariffs spark a global trade war.
We could have a self-inflicted injury that I guarantee you we would regret.
It's just gone 8 a.m. across the Emirates, 5 a.m. here in the UK. I'm Lizzie Burden in London, in for Jemana Besechi. A very good morning. Welcome to Wednesday, the 23rd of April. And if we check in on these markets, it's a picture of relief, if ever I saw one. Green across the screen. You're already seeing gains in the Asia session. Futures pointing higher on both sides of the Atlantic as well. And that reflects relief on many fronts. Relief, as I say, that Donald Trump says he doesn't intend to fire the Fed Chair Jay Powell. Relief that the US Treasury Secretary Scott Bessent says that this trade war with China can't go on forever. And relief specifically for Tesla in that CEO Elon Musk says that at some stage he is going to step back significantly from DOGE. So flip the board and let's look at the cross-asset picture because you can see the relief there as well. Gold actually retreating today. So it had crossed that $3,500 a troy ounce threshold, but now we're down 1.25%. The dollar actually clawing back some of its gains today, so stronger 0.2% on the Bloomberg dollar spot index. You're looking at Bitcoin there having passed the $90,000 mark, which it did for the first time since early March. Remember that, we'll come back to it in just a moment. And the 2-year Treasury yield there at 3.81%. We had a pretty lukewarm Treasury auction yesterday, despite the risk on mood. But flip the board again. I mentioned about Bitcoin, and I just want to zone into this for a moment. I want to show you why it's significant what's going on here. You can see on this chart, if you go from the top down, from the right, you've got Bitcoin, gold, the dollar and the Nasdaq. And as we know, gold has risen amid all this trade war uncertainty. The dollar hasn't been as strong as you might expect amid that sort of uncertainty. Tech stocks have taken a beating. But what's really interesting here is that where Bitcoin used to move more in tandem with US tech, now it's showing signs of decoupling from US tech. And in fact, it's trading more like gold. The white line's gravitational pull is less to the yellow line than the light blue line. So some relief for crypto bulls here, even if we're still well shy of that $109,000 record that Bitcoin reached on President Trump's first day in the White House. So hat tip to the MLive blog for this beautiful chart illustrating all of that. Now, President Trump says that he has no intention of firing the Fed Chair Jerome Powell, despite his frustrations with the central bank not moving quickly to cut interest rates.
No, I have no intention of firing him. I would like to see him be a little more active in terms of his idea to lower interest rates. This is a perfect time to lower interest rates. If he doesn't, is it the end? No, it's not. But it would be good timing. It could have taken place earlier. But no, I have no intention to fire him.
Confused? You're not alone. Let's get more now with Bloomberg's Min Min Lo. Min Min, President Trump there saying that he doesn't want to fire Chair Powell. Remind us, whatever made us think that he did?
Well, it's actually the same argument that you heard him saying on air just now, wanting the Fed to cut rates earlier, if not now. And he previously said that that Jay Powell's termination couldn't come fast enough. But now it looks like the market sell-off in the U.S. has inflicted enough pain for him to soften his rhetoric a little bit. And now he is walking back his statement about firing Jay Powell. But the question here is, despite that rebound and that reversal that we had seen in markets, has it done longer-lasting damage, especially when it comes to credibility in U.S. assets? Because let's face it, when it comes to the U.S. Treasuries as a safe haven bid and the dollar as the global reserve currency, the cornerstone underpinning that it is the independence of the Fed. And so I think at this point there has been a lot of sound bites, but not a lot of actions. Investors still looking for a solid foothold in terms of specifics, whether there will be progress in talks, whether there will be dialing back back of those tariffs in order to put their confidence back for the long term in U.S. assets.
Well, you mentioned tariffs, Min Min. We've had encouraging sounds from the sidelines of those IMF meetings in Washington. We hear that the US Treasury Secretary Scott Bessent's looking for a de-escalation of the tariff standoff with China very soon. But then the president's saying that tariffs won't go to zero either. What do you make of that?
Yeah, it's actually a very interesting shift in President Trump's tone as well, because he was asked by reporters earlier this morning about whether he will be playing hardball with China, and his answer was no. He says those final tariffs are going to be quite far away from 145%, but it's not going to be zero either. But he says China is going to be very, very happy with that deal. He says if China needs to make that deal, and if not, the U.S. is going to set the deal. So it does look like the window for making a deal is cracking open just a slightly teeny bit more, especially with Bessent also reassuring markets in this closed-door investor summit hosted by JP Morgan Chase. He's saying that the standoff is not sustainable. Both sides have to find a way to de-escalate, quote, in the very near future. Although he did caution that any sort of big, comprehensive trade deal will still take a long time, maybe 2 to 3 years to finalize. But look, just given how President Trump has been eating some of his own words when it comes to Powell, it's really hard to discern now whether this is just yet another throwaway comment to shore up market confidence, or is it really a meaningful shift in U.S. stance on China?
OK, well, clearly markets trying to take a bit of the optimism, though. But interesting that the Federal Reserve Governor Adriana Kugler saying that tariffs are going to impact the US economy more than expected. Maybe that's perhaps as well why we're seeing this progress on trade talks with Japan and India.
Yes, Kugler is essentially echoing what Jay Powell has said, that the Fed is going to hold this wait-and-see stance because of all the uncertainty, which she says is not coming from the Fed. It's coming from the U.S. government. And she says there is upside risk to inflation, downside risk to unemployment. And that's why all eyes are on how these bilateral trade deals are going to go. And one of the first to make progress so far is Japan, heading into the second round of trade talks. A few things that are on the table, including perhaps commitment to buy more U.S. agricultural imports, perhaps revising down those car safety standards that would allow more U.S. cars to enter the Japanese markets, maybe even strengthening the yen against the dollar to make U.S. exports more competitive. And of course, there is Japan. J.D. Vance just concluding that trip to India, which shows that India is perhaps ranking among the top in the priority list in that long queue of countries looking to cut a deal with the U.S. as well. But again, specifics still a little bit vague at this moment.
OK, Bloomberg's China correspondent Min Min Lo, we thank you for all of that analysis. Now, the IMF Managing Director Kristalina Georgieva says that the chances of a global recession will rise if uncertainty over a US-led trade war continues.
If we have this cloud of uncertainty coming lower and lower, making it difficult for the business community and for households to take decisions, we could have a self-inflicted injury that I guarantee you we would regret.
Joining us now for more is Greg Wilensky, head of US Fixed Income and head of Core Plus at Janus Henderson Investors. Good to have you with me, Greg, this morning. Thanks for joining. Are you confident at this point that markets are the guardrails on Donald Trump? We saw him walking back on tariffs with that 90-day pause. Now we see him saying, I'm not trying to fire the Fed Chair, Jay Powell. Do you think that he's actually scared of the bond vigilantes?
I think there is some fear there, but I think I'd push back what I say. I'm confident that it will always keep things in line. I don't think I can. I don't think I can come to that conclusion either.
OK, well, seeing as he says he doesn't want to fire Powell, can we forget about that now, or are you still worried about Fed independence?
I'm very relieved to hear that that news today. Obviously, just woke up to seeing that, and it was obviously something that myself and the market is concerned about. The whole idea of Fed independence is still going to be something we're going to have to be aware of, as let's remember, it's only a year from now when even if Powell, and hopefully Powell will not be fired, that Powell's term will end and we will still be concerned about overall maintaining that strong independence of the Federal Reserve, which I think is a key to the stability of our capital markets. It was it was good to hear Scott Bessent last week noting this, and I think that will be the watchword. But given the, let's say, the volatility or uncertainty in which the administration sometimes talks, it's not something we can just put away and forget forever.
I mean, Chair Powell's told us that we can't rely on a Fed put. He made that pretty clear. Are markets reading the Fed's rate path ahead correctly at this point?
I think it's really important that when we look at, the Fed projections or what they're talking about, that we've got to put it through a kind of a scenario analysis type approach, the way Fed Governor Waller mentioned a couple of weeks ago. I think the idea that the Fed's reaction function, depending on the outcome, so as we move forward, if the labor market weakens materially and long-term inflation expectations remain anchored like they are currently, I think you can see them react forcefully to any material weakening in the economy. I don't think they're going to be able, given the level of uncertainty in predicting what the policies will be, which makes it even harder to figure out how the economy will evolve. It's very difficult to come up with an expected scenario for the Federal Reserve's action because it will really depend on the conditions that evolve over time.
OK, so the uncertainty continues, but we've already seen a number of assumptions, conventional wisdoms about markets turned on their heads. I wonder, do you still see the dollar and treasuries as safe havens in these markets?
Feel a lot more comfortable about that today after comments about the Fed independence. I think as long as we have that Fed independence, the ability of the Federal Reserve to act aggressively if the economy weakens will be there. And that is an important thing that holds together the kind of what we call the negative correlation between Treasury yields and riskier assets like stocks or high yield bonds. And that does give us confidence that fixed income, high quality fixed income, can act as a buffer. Weakening of that Fed independence is something that could really call that into question.
Well, where you talk about high quality fixed income, how do you position in this kind of uncertainty? What's the strategy for a portfolio in this sort of climate?
So it's a great question. I think this is a time, given the level of uncertainty, in our view, it's really hard to take large amounts of risk on the macro side. We prefer to do two things. One, really fall back, rely on our deep research that helps us identify individual securities or sectors within the bond market that we think will outperform. Maybe it's because they've been beaten down unnecessarily. Also, as an active manager, one thing that is good about all this uncertainty is it tends to cause the markets to overreact in one direction or another, throw the baby out with the bathwater, and that creates a lot of fertile ground for us to make investments. On the other hand, I think it's really tough on a day-to-day basis with this volatility to make big, let's say, duration calls or big views on whether spreads or risk assets are going to move in or out. So we've generally brought down that part of our risk budget during this period of heightened uncertainty.
OK, really interesting how to play things in this environment. Greg Wilensky, head of US Fixed Income and head of Core Plus over at Janus Henderson Investors. We thank you for joining us this morning. Well, coming up on the programme, President Trump is set to return to the Middle East in search of promised foreign investments. We'll bring you all the details next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Lizzie Burden in London. Now, President Trump is going to be in the Middle East next month for 3 days, though it'll no longer be his first foreign trip as he's attending Pope Francis's funeral in Rome this weekend. President Trump says that he spoke to Israeli Prime Minister Benjamin Netanyahu on Tuesday, adding that they're aligned on every issue. For more, let's get some analysis with Bloomberg's Carla Canivet. Carla, good to have you with me. I want to start with this Middle East trip. Where's Donald Trump going to be stopping off, and what do you think he's planning to achieve?
Well, good morning, Lizzie. So he will be making 3 key stops in Saudi, in Qatar, and in the UAE. And I think it's interesting, even though, as you said, it will no longer be the first trip from Donald Trump, it is still one of the first trips which are unforced. And Trump has been very clear that he's keen on solving the Middle East, if that's a way to put it. So it is, to me, interesting that it is still one of his first key trips. And as he does so, one of the main things that he'll be looking at is nailing down some of the promised investments from these countries that he's visiting. And we're talking about some very big numbers. Saudi Arabia has promised $1 trillion, the UAE $1.4 trillion. These are humongous numbers, they're very big. Even if you are talking about a protracted period of time, over a decade, it's still big numbers. And you've seen Trump be extremely transactional with how he sets up tariffs, how he wants to bring in investment to the US. So I think money is going to be one of the things that we see on these trips.
Yeah, you kind of wonder whether those investments hold after Donald Trump's term, if indeed it ends after 4 years. But I also, Carla, mentioned this conversation with Benjamin Netanyahu. Where does it leave the war in Gaza and other topics that they would have discussed, Iran and trade, for example?
So trade for Israel is also a topic, because even though they have been quite aligned and they are very close allies, I think Israel was taken aback when the first tariffs came through and they realized that we are in the same bucket as everyone else. So Netanyahu, along with several other leaders, have been trying to go to Trump and try to find a way to ease the tariffs. And also on the political side, which is always very important in this relationship, for the war in Gaza, at this juncture, I'm not sure that it changes a whole lot. Trump has had Netanyahu's back on what moves he has made thus far. And of course, they have been since and publicly from the beginning saying that, yes, we are aligned. I think that Netanyahu used the expression, there is no light between this relationship, to mean that we are in sync with every issues. Now, there has been some nervousness from Israel with these conversations about the Iran nuclear energy, but on the outside, they continue to say that we are all aligned and continue.
Yeah. Okay. Carla Canavet, we thank you for that update. And I want to stay on the latest on the war in Gaza. A Hamas delegation has reportedly left for Cairo to discuss what it describes as new ideas aimed at securing that ceasefire in Gaza. AFP says that the renewed diplomatic effort follows Hamas's rejection of Israel's latest proposal to secure the release of hostages held in the Gaza Strip. US Ambassador to Israel, Mike Huckabee, has also urged Hamas to accept a deal that would secure the release of hostages in exchange for humanitarian aid entering Gaza. Well, coming up on the programme, Kenya's President Ruto is in China, so we're going to get the details of what he hopes to achieve there next. So stay with us. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Lizzie Burden in London. Now, the Kenyan President, William Ruto, is in China on a 5-day state visit. He's told Chinese state media that he wants a deepening partnership to accelerate Kenya's modernisation drive. For more, let's go to Bloomberg's Ondiro Oganga, who joins us now. Ondiro, just talk us through the significance of the Kenya-China trade relationship and what exactly President Ruto hopes to achieve on his trip to Beijing.
Hi, Lizzie. So President William Ruto is making it known where his interests lie. China is Kenya's biggest bilateral lender and also Kenya's biggest trade partner. And so by honoring this state visit, President William Ruto is making it very clear where his priorities lie and where he has his eyes fixed on. And this is in contrast to last year when he visited the White House and he was asked, is Kenya facing east or is Kenya facing west? And he said Kenya is facing forward and it's going to align itself with partners who are committed to helping the country achieve its development agenda. Fast forward to barely a year later, it looks like forward is leading east, and you cannot necessarily blame the man. President Donald Trump has slapped 10% reciprocal tariff on Kenyan exports, and U.S. is one of the major markets for Kenyan goods like coffee, tea, fresh cut flowers, fruits and vegetables. And these are goods that not only contribute to the economy but also guarantee inflows of FX. And Kenya is going to lose a significant amount, millions of dollars, because of this tariffs. And this comes at a time when Kenya is dancing on the edge of fiscal vulnerabilities. Kenya opted out of their final IMF review. They lost $800 million because of that. Financing from the World Bank is yet to be unlocked because they're yet to meet all conditionalities. And bilateral lenders would rather the country be under an IMF program before they can release financing. So President William Ruto is hoping that he can secure some budgetary support, secure money to complete stalled infrastructure projects, which will buy him some political goodwill and also bring some form of relief to the Kenyan economy.
Yeah, it's interesting how you've got this kind of dance of bilateral trade talks catalysed by Donald Trump's own trade war, all happening, including especially around China in the background. But of course, as you mentioned, China's got this key role in Kenya's debt composition. It has for a long time. How does this trip play into that?
You're absolutely right, Lizzie. China is one of the biggest driving factor of debt servicing costs in the country. If you look at payment to external creditors, China is ranking higher than Eurobond and also the IMF, according to a parliamentary report of the $39.1 billion owed to external creditors. 5.4 billion of that is owed to China. And if you look at debt servicing costs to China's Exim Bank, it's a quarter of those payments will go to China in terms of debt repayment. So China is a big player in terms of Kenya's debt composition, and a lot of this money has gone into infrastructure projects. China has built the standard gauge railway, which was initially aimed at coming from the port of Mombasa in Kenya all the way to the border in Malaba, connecting trade and also enhancing movement of people and goods. And it's not just in Kenya. China has done big projects across the African continent. It's looking to revamp the Tazara line in Tanzania. It has built a railway line in Nigeria and also dams in the southern part of Africa. But then these projects have brought China influence on the African continent, but dug African countries into a deep hole of debt. And China is beginning to pull back. We saw during the Africa-China summit, they only pledged $50 billion, and they're trying to move away from big projects and also lend money to countries that are not heavily indebted to them.
OK, Bloomberg's Ondiri Oganga from Kigali in Rwanda. We thank you for that update. Coming up, as India and Saudi Arabia reach an energy deal, we'll look at the ties between the two. That's next. This is Bloomberg. This is Horizon's Middle East and Africa. Our top stories this morning. Relief rally. Stocks and the dollar rise after President Trump says he has, quote, no intention of firing Fed Chair Jay Powell. Mideast mission. The US president plans a return visit to the region in May as he seeks to confirm trillions of dollars of investment from Saudi Arabia, the UAE and Qatar. And the IMF slashes its global growth forecast for this year and next, warning it could get worse if US tariffs spark a global trade war.
We could have a self-inflicted injury that I guarantee you we would regret.
Well, it's just gone 8:30 a.m. across the Emirates, 5:30 a.m. here in the UK. I'm Lizzie Burden in London, in for Jemana Basetchi. A very good morning to you. Welcome to Wednesday, and it's a risk-off session so far. Already, the MSCI Asia Pacific Index is up 1.7%, and futures pointing higher on both sides of the Atlantic, thanks to that relief around Donald Trump saying that he doesn't want to fire Jay Powell. Scott Bessent, the US Treasury Secretary, saying that this trade war with China, it can't go on forever. And if we look over to the cross-asset picture as well. You can see the relief there too. So gold is actually retreating this morning, down 1.25%. It had crossed that $3,500 a troy ounce level yesterday, but we're coming back from that now. The dollar actually clawing back some gains here, and Barclays CEO CS Venkatakrishnan saying, don't worry, it is absolutely going to stay the world's reserve currency, the dollar. So not something that we need to be thinking about now, at least he says. Meanwhile, you've got Bitcoin there past the $90,000 mark. That's for the first time since March, and we'll come back to that in just a moment. And the 2-year Treasury yield currently at 3.81%. We did have a pretty lukewarm Treasury auction yesterday, despite the risk on mood, but 3.81% is where we are on the yield currently. Let's just have a quick look at the Bitcoin story. We've got a great chart here, courtesy of the MLive blog, and you can see that on this chart you've got gold in yellow, white Bitcoin, NASDAQ, the light blue line, and the Bloomberg Dollar Spot Index there in the kind of purple. And what we've seen amid the trade war uncertainty really is, of course, the dollar hasn't been as strong as you'd expect. Tech stocks have taken a beating. But where Bitcoin used to move in tandem with US tech, now it's showing signs of decoupling from them. You can see that at the far right of the chart, and actually it's trading more like gold. So some relief for the crypto bulls, even if we're still well shy of that $109,000 record that Bitcoin reached on President Trump's first day in the White House. Good chart there. Do take a look at the MLive blog for more insights like that. But let's get back to the Middle East, because we've got a deal. Saudi Arabia and India have agreed to deepen energy ties and cooperate more closely on tourism and technology amid the global economic turbulence. Their leaders met as both countries look to support their economies against US tariff policies that threaten to stunt growth. And we can get analysis now with Bloomberg's energy reporter Anthony Di Paola, who joins us from Dubai. Anthony, I just wonder how significant this agreement is, because we've got so many of these bilateral talks happening around the world, catalysed by Donald Trump. We've discussed a few of them already. How important is this one?
Yeah, good morning, Lizzie. Exactly as you say, there are a lot of these deals, and we've seen a lot of these announced between Gulf countries, between India over the years, over recent years even. So let's wait and see what comes out of these agreements. So these are agreements that the countries will want to work together to deepen ties. And of course, there is a strong tie in terms of energy supply between Saudi Arabia and India. Saudi is a major oil supplier there. Now, some of the Gulf supplies have gone down into India, as India looks to buy more Russian supply because those barrels have come in more cheaply on a spot basis. So that's impacted some of the supply. But Saudi Arabia is a really reliable, long-term supplier of oil to many of the Asian countries, India in particular. So that's going to continue. There were some discussions around some refinery plans there. And of course, Saudi Arabia and India do want to work together on refineries, but we have seen discussion of this before without actual refinery projects materializing. And of course, we are in a pretty tricky spot for the market with oil under pressure and some of the refinery margins down. So it's not an amazing time to invest in a refinery at the moment. Of course, these are long-term decisions, so we'll see how that does play out, Lizzie, whether that does become an actual project.
Yeah, I mean, we're asking that same question about lots of these pledges of investment, including from companies into the US at the moment. When they've got these long horizons, will they last beyond Trump's term? But I also know that you've just had J.D. Vance in India, the US Vice President, of course. Now you've had Modi in Saudi Arabia. Is it fair to say that India's kind of hedging its bets and weathering the trade turbulence better than some of its rivals?
Yeah, of course, the U.S. is a major trade partner for India, so that's an important relationship for them to keep up. But they've always had this relationship with Saudi Arabia there, and they're more dependent really on Saudi for oil. From the U.S., they could in the future get LNG as LNG comes onto the market more increasingly from the U.S. Some of the lighter oil that's supplied from U.S. shale is very important. But of course, it's, the U.S. and Saudi are also allied countries, as is India. So it's kind of a meeting of minds in that way. Of course, the Trump administration has great admiration for the Saudis and Crown Prince Mohammed bin Salman, as he does for Prime Minister Modi in India. So it is kind of a meeting of minds in terms of moving forward with economy. Both Saudi Arabia and India have huge growth plans and lots of work to do. So they need each other. They need the U.S. and they need to stay in the good books of the U.S. Of course, the Gulf countries got that minimum 10% tariff, which of course isn't good for them, but better than a lot of countries. And remember, the Gulf countries are very linked to the United States because the currencies here are pegged to the dollar. Oil being traded in the dollar is the main international currency. So they're very linked to the U.S. economy and to U.S. interest rates as well, and mainly that oil price. So they're very dollar-linked economies here, Lizzie.
Anthony DePaola, good to see you, Bloomberg's energy reporter. We thank you. And I want to continue this conversation now with Rachel Ziemba, founder of Ziemba Insights. And Rachel, good to have you. I want to just start where we left off with Anthony on Modi's visit to Saudi Arabia. What does it say to you about the relative influence of Saudi Arabia versus the UAE when it comes to India?
Yeah, both countries have been very interested in closer ties with India. As Anthony mentioned, there have been past pledges from Saudi Arabia, but not a lot of joint investment. We've actually seen more, sort of joint investment of the sovereign funds of Abu Dhabi into India in construction and other areas. The Saudis may be interested here as well. I was struck by the energy deal, the plan, which involves joint work on some refineries in India. India, like other places in Asia and the Middle East, has been adding refinery capacity. It's been leveraging the energy, so the cheap energy from Russia. And that kind of partnership sounds a bit to me like the kinds of things Aramco was doing in China some years ago. So I think this is a logical step for nearby neighbors, one energy poor, one energy rich, to partner more, and for Saudi Arabia to look for insights on how to build its advanced manufacturing sector. India has benefited from China plus one strategies, and both of these countries, as you say, are trying to hedge in this time of greater US-China competition.
OK, really interesting. And we note in the corner of the screen, we just saw that you're on the ground in Washington. I know you've been at some of the IMF World Bank spring meetings. What's been your key takeaways so far?
I think everyone is trying to understand where US policy is going and thus global growth, right? We had the IMF come out with their numbers this morning, a downgrade in global growth. I think some of those numbers people think look a little optimistic even now. But I think people are waiting to see what sort of deals materialize, whether it's with countries like Japan or South Korea, whether the tariffs stay in abeyance. And I think we're maybe optimistic, we're positively surprised by Scott Bessent's comment that China and the US might de-escalate. I'm not sure how that fits with the comments he made last week that other countries should hike tariffs against China in concert with the US. And it's important to remember that regardless, people are thinking about US assets in a different way. I think there are a lot of long-term investors that don't want to invest in the US unhedged anymore. And so some of that will be with us regardless of exactly where things go on tariffs going forward.
Well, would you say that the dollar's lost its safe haven status?
Yeah, I think some of that sheen is off. The dollar market is still the most liquid market, the largest market, easy to go in, easy to go out. But there are some alternatives that are starting to look a little more attractive. The Europeans plan to issue more, right? That's always been a challenge. Gold has probably emerged as as one of the places people have gone. You noted that, in a risk on moment, it sold off this morning. I think gold, though, is a tricky one to actually use in a real crisis moment. It's not as liquid as people think it is. But ultimately, I still think the dollar will be highly used. But the Trump administration is going to have to make its fiscal trajectory clear. The meetings I was in today suggest that the U.S. fiscal position, the debt and deficit are just going to be getting worse. And I think that the investment incentive side of the equation, investing in the U.S., there's still some more details needed there. We still don't know if Gulf sovereign investment will be welcomed into the United States in a meaningful way. Trump might say he wants it, but the CFIUS process can still make it somewhat difficult to invest in some of the sectors they're trying to attract investment in.
But you mentioned gold. I know it's pulled back from that $3,500 level, Rachel, but surely it's acting as if the US is already in recession. You mentioned that IMF forecast. Even they're not saying that recession is the base case. Yes, it's a danger, but do you expect more of a pullback on gold then?
Not particularly. I mean, gold is by far the winning asset this year, and it was quite a winning asset last year as well, despite some ups and downs, to the extent that recycling of gold and gold scraps became quite, quite attractive. So yeah, I mean, I think intraday small moves don't miss that point. It does feel to me that the forecasts for the U.S. economy that the IMF published today look a bit optimistic. We'll see how that plays out. Especially, we've seen an investment limbo materialize in the U.S. economy due to the tariffs, due to other taxes like the shipping fees, and so I think that's going to be a challenge going forward.
Indeed, those forecasts often prove to be optimistic, don't they, out of the IMF after we look back at a crisis. Rachel Ziemba, really good to have you, as always, on Horizons.
Thank you, Lizzie.
That's Rachel Ziemba, founder of Ziemba Insights. We thank you. Now, just going back to India, Prime Minister Narendra Modi, of course, cut his trip to Saudi Arabia short. It was meant to be for 2 days, but this was because gunmen killed as many as 26 people in India's northern Jammu and Kashmir region. The Press Trust of India says that the attackers opened fire on tourists and 2 foreigners were among those killed. The US Vice President J.D. Vance is currently visiting India, and he described the attack as horrific, while President Trump offered his full support. So that's on the latest there. But coming up on the programme, Tesla's stock has been climbing after CEO Elon Musk vowed to pull back significantly from his work with the US government. So we'll bring you more on the company's first quarter results next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Lizzie Burden in London, where it's just gone 5:46 a.m. Now, to those Tesla earnings, Elon Musk says that he's going to devote more time to Tesla starting next month, as his stint leading the so-called Department of Government Efficiency, DOGE, is going to be largely complete. Investors have taken Musk's decision to focus on the EV maker as a positive move.
Starting probably in next month, in May, my time allocation to DOGE will drop significantly. I'll have to continue doing it for, I think, probably the remainder of the president's term, just to make sure that the waste and fraud that we stop does not come roaring back.
So that announcement was really the focus for investors. The stock rising in late trade after the announcement, despite the company's first quarter results missing analyst estimates. Let's get more now with Bloomberg's Asia Global Business Managing Editor, Rachel Chang. Rachel, are investors focused on the right thing here? Is their positive sentiment misplaced, perhaps?
Right. I mean, it was very interesting for, that stock to close up higher 5% when, the earnings did look pretty bad, sales and profit both down. We know that Tesla also took away its forecast that it would return to growth this year. It can't say for certain now. So on the numbers front, it's not looking that good for Tesla. But I think, investors are just really looking for something positive for this company right now. And, Elon Musk did build this company into what it is, that EV pioneer that has such a hold hold on the culture. And Tesla really does need to do a lot to get back into the game in terms of EVs. Its biggest challenge really is the competition posed by the Chinese manufacturers, BYD, who's doing such a good job around the world. And I think investors are just really looking to the fact that, okay, now we're going to have somebody back at the helm of this company and hopefully putting it in the right direction right now.
Yeah, we were talking about cars that can charge in 5 minutes yesterday. You've got that threat, you've got the tariff threat. That's not going away, maybe. What does Tesla need to do right now to right the ship, apart from getting Elon back?
Right, exactly. I mean, Tesla is just facing so many challenges, problems on different fronts, as you said. The fast charging batteries from the Chinese EV makers are just so competitive. Tariffs will be an issue for Tesla as well. Although most of their cars are built, in the U.S., there is still a component that will cause rising prices for consumers. And the biggest thing really facing Tesla right now is that there's just been such a surge of really good, affordable EVs from the Chinese makers, but also all the global car makers. Tesla's models are very expensive. They're on that premium high end for the higher end driver. And to really get growth going again, they do need that affordable model that they've promised for a long time to come through. Elon Musk said that affordable model will be launched in the first half of this year, although people are worried about continued delays. But that model is seen as really the key for them to unlock that mass market again. So he really has to come through with that promise. And going forward, so much has been invested into autonomous driving. He said again, millions of people will be sleeping in their cars as they cross the country overnight on the roads. People still are hopeful that Tesla will be that first mover in that technology. And once again, there has been so much faith in him for bringing Tesla to where it is right now. Him coming back to the company and really making sure that it delivers on those promises, is going to be a big deal.
Okay, Bloomberg's Asia Global Business Managing Editor Rachel Chang, we thank you for joining those dots for us. And I just want to stay with tech news because we've had a redhead across the terminal earlier this morning that Intel is said to be poised to announce plans this week to cut more than 20% of its staff. A source says that the move is part of a bid to streamline management, eliminate bureaucracy and rebuild an engineering-driven culture at the struggling chip maker. Now, these cuts would be the first major restructuring under the new CEO, Lip Bhutan, who took charge last month. And Intel last year slashed around 15,000 jobs already. Well, coming up on the programme, concerns that Dubai's booming luxury property market could face a threat from Trump's tariff turmoil. We'll bring you all the details next. This is Bloomberg. Welcome back. Now, Dubai's luxury property market just keeps on booming. Research by Knight Frank shows that it hit a fresh record in the first quarter, with wealthy buyers again driving record sales of homes valued above $10 million. For more, we're joined by Bloomberg Middle East finance reporter Zainab Fatah. Zainab, just tell us what's been driving Dubai's property boom in the long term and most recently.
Well, this has been happening for at least about 4 years or since 2020, and that's basically driven mostly by an influx of foreigners, mostly millionaires and billionaires moving into the city or buying property here. So Henley & Partners estimated that in 2024 alone, we had around 6,700 millionaires who moved into the city and bought property. That started to happen, as we saw after the pandemic, as Dubai reopened its economy quicker than other countries. Schools reopened before other countries. And we saw, of course, the change in visa regulations that made it the first place in the Gulf that you're able to actually get a visa that's not related to your job. And in many ways, that was appealing to a lot of investors who started piling into the property market after 7 years of decline.
But I mean, what are the risks to this going forward? Surely it's got to end sometime, she says. I look at the oil price up today, but that's been falling. Is that potentially a threat to this boom?
Well, definitely the oil price is actually fundamental to this region, and it's always something that people watch when they're looking at the fortunes and expectations for the region. A lot of the spending in the Gulf is driven by governments, whether in Saudi Arabia building ginormous projects or in the UAE, building infrastructure and so on. Those type of projects and the companies that base themselves here, they depend a lot on government contracts. And a cut in spending from governments across the Gulf because of lower oil price could actually impact jobs and lead to job losses across the Gulf.
And just quickly, what are you hearing about the tariff impact of supply chains for construction?
A lot is unclear at this point because there is a lot of, while this supply chain issues might not impact us directly, it could actually have some impact in a different way, whether raising the prices or meaning that some supply chains could get cut. The one thing that people say, there are a lot of unknowns about this, but the one thing that could actually impact us if there was a reduction in the number of homes coming into the market or if prices shoot up, that could mean we will see a decline in the number of properties on the market, and that could basically moderate the amount of supply coming to the market.
Okay, Bloomberg's Middle East finance reporter Zainab Fattah, we thank you for that update. And just a quick update on some other news on this subject. The Stanley Hotel, which of course inspired Stephen King to write The Shining, is planning to borrow nearly $300 million to fund a major renovation and expansion. The hotel in Estes Park, Colorado, aims to cement its status in the film industry and attract more regional tourism. Well, here's Johnny. That does it for Horizons. Daybreak's up next with Tom Mackenzie. So stay with us. This is Bloomberg.